Good morning and welcome everybody. Thank you for registering for today's webinar all about mergers and acquisitions in hospitality. It's 10 a.m. It's Tuesday, the 4th of June, 2024. My name is Jane Pendlebury. I'm the CEO of HOSPA, the Hospitality Professionals Association. Firstly, I'm going to introduce you to Max Palmer-Jeffrey, who we often have the pleasure of working with. Max is working with Howden, who kindly sponsor many of our activities here at HOSPA. Max.
Good morning, everyone. Just start by introducing myself. I'm Max Palmer-Jeffrey, Client Relationship Manager at Howden. Thank you for joining our webinar in collaboration with HOSPA. I also just want to take a few minutes to introduce Howden before we start. Howden is one of the largest insurance groups in the world. We're also the 5th largest employee-owned business in the UK. Through our partnership with HOSPA, our aim is to give advice on the risks that are associated within the hospitality industry, so you can rest easy knowing that your business is protected properly. Which leads me on to pass over to Jane, AJ, Alex, and Jane to discuss how to navigate M&A within the industry.
Brilliant. Thank you, Max. You mentioned Jane there. We are meant to be joined today by Jane Lees from Deloitte, but she's at the mercy of our rail system here and is currently stuck. So she may join us a bit later on. We're due to be chatting for around 30 to 40 minutes today with time for questions. So please do ask questions throughout using the Q&A option, which will probably be at the bottom of your screen. If there's not enough time to answer all the queries, then we will get back to you afterwards. So I'm delighted to be joined so far by two of our panelists, AJ Jones from Howden and Alex Slaws, who runs his own consultancy on hotel asset management and also generally hotel development. Alex also supports HOSPA's Asset Management Professional Development course, so it's great to have him here with us today. If Jane joins us, we will get her to do a quick intro, but I'm just going to start now by handing over to AJ to introduce himself, and then Alex, if you'd like to go next.
Super. Thanks, Jane. So my name's AJ Jones. I'm Associate Director here at Howden M&A. Now, my role is effectively to co-lead the team on the placement of W&I insurance on real estate transactions across the UK. So it's a bit of a mouthful, but that's everything from single assets in logistics all the way to operational platforms and portfolios and everything in between. So I've been at Howden for 7 years. I've always brokered W&I insurance, and prior to that, I had a financial services background.
Brilliant. Thank you, Alex.
Hi, my name is Alex Slaws. I've worked in the hospitality industry all my life. And the last 17, 18 years, I've been an independent consultant doing asset management, but essentially bringing owners and investors together with hotel brands and, most importantly, the people that actually physically work in the hotels and making sure that there are synergies in between those three parties for the overall benefit and growth of a hotel. And more recently, I am working in education through the HOSPA courses, which are online, but also as program director in real estate finance and hotel development at the Lyon University. That's me.
Brilliant. Thank you very much, Alex and AJ. Well, let's start at the beginning. AJ, could you just sort of set the scene and tell us what the current state of the hospitality M&A marketplace is?
Yeah, absolutely. So I can come at it from what we're seeing within the transactional space. As a broker, it's a very interesting position to be in. We get a pretty good overview of M&A landscape, and given our positioning in the market at Howden, so we've got 14 offices across Europe and APAC. That visibility, it goes fairly wide. So everyone loves a good stat, but without being too facetious, we're generally a pretty good barometer of how the M&A market is doing and the sentiment. Generally speaking, total volumes of transactions that we've insured. We're level pegging for last year. So I suspect that by the end of September, extrapolating out the current run rate, we'll probably be insuring 350 real estate transactions across the market. So that's Europe, UK and Europe. That's potentially a bit more of a nudge than last year that we did, but still, I clarify that is only just real estate. We are, though, down about 30 to 35% from 2022 M&A volumes. So there's a lot of headroom for growth there. And to get back to that par. Now, if I speak to our investor clients and their sentiment, that feels about right. We're getting back on track. The market's moving in the right direction, albeit there is, a little bit of uncertainty this year with all the, the political decisions globally that are going to be made. What's interesting, though, is when you distill the numbers down, hospitality in particular, what the hospitality sector is doing, it's accounting for a far larger proportion of deals than we're used to seeing. So maybe 2 or 3 years ago, maybe 1 in 8 transactions will have been hospitality or leisure. Whereas now it's about a quarter of all the inquiries we're getting in the UK at the moment. They are within the hotel, specifically hotel space. It's by far the most resilient sector that we're seeing. It's showing almost double proportionate growth of all other sectors. And I think that's a trend which is shared across Europe. Now, of those transactions that we're seeing, it isn't just the single assets. It's larger portfolios and even platform big ticket chains, which people are transacting on, which is definitely showing confidence in the asset class. The deals, though, they are pretty fraught, but fairly fragile as well. You know, they're taking a long time to get done. And deal origination, I think, is one of the key hurdles that people have got to overcome. To put it crudely, you know, there's a lot of flirting, a bit less dating in the market, if it was sort of, you know, characterize it as such. But I think I was speaking to a client not too long ago in the private equity space, who I think summed it up very well. Last year, you know, there was plenty of money on the stocks, but nobody could get ICs on board to deploy capital. There was just, you know, too much fragility in the market. This year, though, everyone's primed. They're more optimistic. Lots of money's being committed on the capital side. And crucially, though, the ICs, they're buying into transactions and the deals they are getting done. People know what they're buying, whether it be development or, you know, standing assets. But the problem, it seems to be one of supply. The stock is just lower in the market at the moment. And so taking that sentiment, overlaying it with our experience, I think it boils down to sellers are finding it very, very hard to get to buyer expectations on price. And it's becoming harder to take a view on commercial issues, you know, whether that be capex provisions or accruals or potentially identified issues in a deal. So people are becoming far more focused on realizing the full value of an asset and getting clean breaks against the backdrop of dwindling exit yields. And certainly for us, that means that, you know, we're seeing a lot more people turn to W&I insurance, to specific and risk insurance, to try and mitigate that risk and grease the wheels of a deal getting done. Use insurance as a transaction tool rather than just a risk transfer.
Wow, that's super interesting and great to hear that it's overall positive. We always like to put positive spin on everything here at Hosper, so that's great news. And you used the word resilient there. I remember using that so much during the pandemic. The resilience of the market was incredible. I swore I'd never use it again, so I'll try not to say it again now. So Alex, given what you do with your clients, can you take us through when it's appropriate to sell a business? I know that you specialize in maximizing the value of an asset at any stage of its life cycle. But could you start with when the best time to sell a business is and talk us through that?
Yeah, it's a very difficult decision. I mean, when is the most appropriate? The one thing you need to consider, and where hotel assets are essentially different from other real estate, is that the valuation of a hotel happens based on the trade and based on the trading results and basically on the net operating income, which is your EBITDA minus any FF&E reserves that you need to do. So the better you're doing, the valuation goes up. But what AJ just mentioned is also very interesting. There is obviously the expectation that my hotel is perfect at the moment and it's primed to do, and the buyer probably has a different interpretation of that. So you need to look at those two things. And I think what is important as well is when you sell a business, you always have to sell an opportunity. Because face it, if a hotel is perfect in the way it trades, and let's say you're trading at 95% occupancy and your RGI is 200, yeah, so you're really doing everything that's right, then the next acquirer would not be able to add any value to it, and that sort of defies the purpose of the transaction. So I think two things are important. At some stage you need to say, and that could be on the crest of the wave, yeah, but it could also when there is a significant need of capex, yeah. And face it, the buyer will always think, people, it's natural, inherent in people, they think they can do better than their predecessor. We all have this. And I think it's very, very important that you play a little bit on that. So if a hotel is up for sale, or I would show the crappy rooms, and I would say you can do an improvement here. You could look at that space there. If you work it, you could do a little spa. You could do anything incremental to drive that business forward and to take it from that point of sale up to the next level. I think that's it. But just to complete it, what is also important is, I think you need to have your house in order. Going to market And not having your house in order could be very embarrassing and would have a negative impact on actually the price of what you sell. So it's super, super important for all parties involved that your accounts are up to date, that you know exactly what's where, that all your filing is done, that your data room looks nice and clean, because that would be the foundation to sell, and that would be a good moment. So take your time for it, spend some money on it as well, because face it, otherwise the other side is going to spend some money and they somehow going to take it off anyway. So I hope that answers your question.
Brilliant, it does indeed. But of all those things, what do you think owners and their representatives, the asset managers, should be prioritizing before starting the sales process? Is there a list of priorities? What's the most important?
I think all due diligence is important, but I think as a seller, you have to facilitate that. You need to make sure that what you have, because otherwise, the process is going to take a lot longer. I mean, we were sort of dating now, but in order to sort of tie the knot would take a long time. And at the same time, the impression in between buyer and seller is going to be difficult. So your due diligence in every single area, that could be technical, that could be environmental, that could be commercial. If your house is in order there, the deal will go through quite easily. If not, you're going to face lots of challenges, and but likely, I mean, from that perspective, an insurance preposition would be interesting and would actually be very valuable if that's not the case. But if you have a perfect, and there is something called a vendor due diligence, which basically means that the vendor is doing the DD, then you got a good basis to move forward quickly and to see if it works. Because when it gets acrimonial and it gets bad, it just doesn't work. And things drag on for years sometimes before a deal is done. But by that time, the opportunity could be gone. And B, the whole relationship is just not very good.
That's probably a great time for me to pick up on something that AJ said earlier on about W&I, warranty and indemnity insurance. AJ, do you want to just explain a little bit more about that and where it fits in?
Yeah, absolutely. So to try and avoid everyone getting bewildered with acronyms, luckily W&I, it's nice and short. W&I, warranty and indemnity insurance. Now, effectively what it is, it's a risk allocation tool which facilitates seller clean exits on transactions and allows buyers to claim directly against A-rated insurers for breaches of seller warranties or claims under tax indemnities or tax covenants pursuant to any sale and purchase contracts that you might be entering into. So coming at it another way, it's a totally synthetic liability structure by way of an insurance policy that steps into the shoes of a seller when standing behind any warranties. So as a buyer, any recourse that you would want for a seller in a transaction for unknown issues, those things which are protected by the tax warranties, the tax indemnity, they can in theory be pushed to the insurance market. Now, I think the key point here is that it's there to cover the unknown issues. So W&I, it's there to protect buyers which for those losses which go to value after they've gone through a thorough due diligence and a disclosure process with the sell side. So it's those true undisclosed, unknown issues that can in theory be insured away, but those ones that remain with a business on acquisition. You know, the nature of those risks, because the policies they tie to seller warranties, you know, statements of fact that the seller gives you about the business when you buy it, they are backward looking. So the key thing here is that W&I, it's, as much as, you know, I wish it was, I'd be a very rich man if it was, it's not a policy that hedges you for future business performance, but rather one that looks to make a buyer whole if it suffers a loss that's, you know, manifested long before its acquisition. You know, with all of that being said, you know, despite invariably being held by a buyer, W&I is effectively a seller product though, because it facilitates the clean exit, it boosts the internal rate of return, which goes back to the point I was making earlier, making sure that sellers can realize the full value of the, you know, the disposal of the business without tying things up in escrows and indemnities. But it can also be used to unlock negotiations around parameters for recourse, as the cover that you can achieve with insurance is very often broader than what any reasonable seller is going to be willing to offer in an uninsured context. So that might be things around financial caps. It could be, you know, time limitations for claims, scope of warranties, or otherwise. So with all of that in mind, the W&I policy, it's not there just as a risk transfer. it's there to also maintain process integrity. And it comes back to the point that Alex was making, actually, teeing everything up, getting your business ready for sale, making sure that you are becoming as attractive as a transacting party as possible, not letting it sour, not letting it go, acrimonious. And so what we can do is, even though policies, they're held by buyers, we very often start the process on the sell side. And that's what we call stapling. So stapling a policy, what it does is it gives parties total visibility on expected coverage earlier in the process, and also helps reduce workload for both sides, which I think everybody's in favor for. Now, depending on the extent to which you hard staple or soft staple a policy, you could end up with either just going out and producing terms and pricing so that everybody's got an idea of the quotes that you have, or, as Alex said, if you are going out and doing vendor due diligence, whether that be technical, environmental, commercial, but mainly for the insurers, what they're going to be focusing on are things like legal, financial, and tax. You can actually underwrite the policy nearly fully on the sell side with no input from the buyer until the very, very last minute, where you flip over and present almost a fully insured, underwritten policy. Processes like that are very, very common on large cap transactions, those where there are competitive auctions, which you want to maintain competitive tension in a process for as long as possible. So the onus on whether you hard staple or soft staple is various document provisions. But in short, in a market where liability structuring is key and where often there are protracted processes, we are always advising our clients to get things started on the sell side, really just to minimize execution risk. Put you as a seller in control of a process which is ultimately going to be core to the transaction. A lot of deals in the current market in the private M&A space, they don't happen unless they are W&I backed. And so it's a linchpin of a lot of private M&A deals, and market data suggests that that's a trend that's only growing as well.
And you may not be able to answer this question, but I'm very curious. Have you seen claims? What if there is a claim? Is there a typical one? Is there a typical kind of claim on the M&I?
Yeah, absolutely. No, not at all. So it's very good. Maybe I can come at it from 2 points, actually. So there's the risks that you're looking to try and mitigate via the insurance, but then actually, what are the claims that we're seeing? So if I look at the risks that you're trying to get around in the hospitality sector, in theory, you could claim for any breach of warranty that you've got. So that's everything from ownership of the shares, ownership of the real estate, unknown litigation, tax liabilities, accounting liabilities. But very, very commonly, there are breaches of key subsectors of warranties. So they're things like accounts, tax, or compliance with laws, often a hybrid of all of those. Now, hot topics within hotels, hospitality, leisure at the moment, it's everybody loves it. Coronavirus job retention scheme, utilization of government grants, any correct claims, and whether or not there is a risk of clawback. I think for a lot of trading businesses, there were VAT holidays given during COVID to try and ease the cash flow for businesses as well. We're still seeing the aftermath of that working through. I think there have been a number of high-profile claims to do with national minimum wage compliance, and how that might be affected by things like uniform purchases. The benign, boring issues that everybody ignores and doesn't necessarily want to focus on, but which, when they're uncovered in due diligence, can really be quite significant. Imagine if you've got 10,000 employees or 2,000 employees, all of whom are hovering on that national minimum wage line. It can make for some meaningful liabilities there. But I think as well, things like employee misclassification, and whether or not you should be paying PAYE and national insurance contributions to people incorrectly deemed as contractors rather than employees. And then I think finally, to round it off, something like cyber insurance, cyber claims. There was obviously the high profile data breach from a global hotel chain a few years ago. I think the insurance market is still suffering a little bit from that. And so from the insurer's perspective, they are looking and they are focusing on issues which are inherent within businesses before you have bought it, things which are totally outside of a buyer's control. And so getting them comfortable that there are robust cyber policies in place can be quite key. But to maybe put a bit of color onto your direct question, coming back to it, what claims have we seen? Maybe I can give 1 or 2 examples. So I think that looking at the aggregate data, about 12% of policies they will be notified on, which is a far higher proportion, I think, than people might expect, because I've spoken with corporate lawyers and private equity houses and corporate buyers who, in 20 years of having done transactions, they've never experienced a warranty claim or a claim under a tax covenant. Whereas, you know, you put W&I in the mix, and, you know, that's what it's there for, to respond for claims, but it is a higher proportion than it might have used to have been. But there are two key themes when you boil it down to hospitality. I think a lot of them come to non-disclosure of contracts or variations to them. And then the other one, which Alex, you might have a view on as well, is incorrect accounting policies. So taking the first point, it's, you know, non-disclosed termination of material contracts. So in something like a hotel, I remember an insurer in the market, they received a claim that was effectively termination of a corporate agreement, you know, for an airline, you know, bulk buying rooms on, you know, a forward basis. That was terminated about a month before going ahead with the transaction. And that was, you know, 35% of their revenue in, you know, for that business. And when it comes back to what you were saying, Alex, it's the business that you're buying, it's the opportunity, but also it's basically the revenue that you're getting. That's quite a big hit that you can take there. There was another one that's, you know, to do with undisclosed leases for equipment, which obviously will go down recorded as a liability in the books. But if you're leasing 20,000 dishwashers across 5 countries, it's quite expensive to do that. So I think that's the first bucket of claims that you see. And the next, it's incorrect accounting policies. So you could potentially incorrectly capitalize certain items on your balance sheet, which could lead to overstatement of profit. There was one where somebody was capitalizing all the leased equipment instead of, you know, recording it as a liability. So across a portfolio, that can be quite substantial.
That's a great
A couple
segue.
of questions come in for you, but Alex, did you want to add anything there?
Yeah, that's a great segue. And I made some notes and I saw them sort of ebbing away as you started talking about balance sheets. But let me give my share on it. I think what AJ was saying is very important, because you're buying a going concern. The valuation of that going concern is done based on your profit and loss account, and it's very much on the profit that you make. Yeah, that defines the valuation of your hotel. But simultaneously, you need to have control on your balance sheet and particularly working capital. Yeah. And you don't always have time, and there's not always sufficient detail available during the due diligence. So it gives peace of mind for both parties, yeah, to have a W&I insurance in place, because you can move on with the business. But it's very important because your assets and your liabilities are sitting in your balance sheet. If your balance sheet, you don't know what's coming at you or what's not expected, and that could be a contract that is being cancelled at the last minute, but it could also be bookings that are on the system that are duplicated, for instance, and that happens a lot. Yeah, especially like a long way forward, and that the business on the books is actually looking better than it should do. And it's the balancing between those two where you need a breathing space to get your feet under the table and to actually identify, is this right? Another great example is stocks, because you don't have time during the DD and you don't always have access to actually find what is really in your stock levels. Is there stuff out of date? I did a hotel once where which was open for 7 years, but all the gifts from the opening party were still counted as sales and marketing stock. And that was a significant amount for a very material hotel in a large capital in Europe. That's big amounts of money, yeah? They're being paid for as part of the transaction. And once that irons out, that in this particular case, we were talking about millions of dollars in order to rectify that situation. Now, if that pressure goes away, yeah, and there is an insurance in place to take care of that, then the buyer can move on with the business and the seller could sort of close it off and move forward as well. And I think that's a very, very good tool.
Interesting. Yeah, it's amazing what people can find in the back of a store cabinet, isn't it? What's there? I thought you were going to say something was horrible, 7 years out of date or something from some stock.
I have some other examples.
I'm sure you do. AJ, you mentioned cyber risks and whatever. There's a question here that specifically for you. Has CIS compliance come up in any claims? I don't know, maybe you think you've already answered that one. I don't know if you want to answer that one in any more detail, or if you think you don't want to commit to any further comment on that.
No, so I think that, you know, that there have been notifications in the market that come down to you know, data breaches and claiming for things like data breaches, you know, in what capacity that might be, usually brought under things like GDPR. I think that the crux of what it always comes back to is, you know, from an underwriting perspective, the way the underwriters that get comfortable with underwriting these risks is for any warranty, you need to effectively verify the subject matter of it through your diligence process. And so the things that they're going to be focusing on is if you've got warranties that say the IT systems are, adequate for a business of this size and nature, appropriate for continued use of the businesses going on, you have an adequate underlying cyber insurance policy in place. The insurers, they want to see independent technical diligence coming and analyzing, verifying, the integrity of those cyber systems, doing penetration testing, making sure that, in the event of a cyber breach, how well defended are you, but also then looking to alternate avenues of recourse. W&I, it is there to protect you for claims which go to value, but it's not a panacea for every other insurance line. There is an expectation that for operating businesses, you will maintain day-to-day insurances. And if you are a data processor, as a lot of, or certainly data controller, as a lot of hotel chains are, hospitality chains, then there is an expectation baseline that you will have those appropriate measures in place to prevent any claim there.
Okay, and when this attendee put in CIS, I was thinking of Centre for Internet Security. They've actually clarified and said it's construction industry scheme compliance. So sorry, I took you down a path there. So
yes.
could you cover construction industry?
I can also speak. It's quite funny when you say CIS. It's so the construction industry scheme, the cyber one, or also the collective investment scheme for JPUTs and GPUT structures. But coming back to construction industry scheme, yes, this is very often a focus of insurers and underwriting, particularly, obviously where you've had large scale refurbishments or you've had any development work. Whether or not we've seen claims on it, to my knowledge, I don't think Howden has received a claim on it. But what I can say is that it's always something which is flagged in the underwriter review of the W&I process. And what they're effectively wanting to look at here, where they're really going to be pinged for it, is checking whether or not your subcontractors, they've got gross payment status. That's often where all of the discussions come back to. And I suppose this is something that when you're when you're a seller, or indeed when you're a buyer, when you're doing your due diligence, it's vital that you're in, close contact with your tax advisors, your legal advisors, making sure that the seller is disclosing everything that you need in order to be able to verify that, getting in contact with the subcontractors, opening a dialogue with them, getting them to demonstrate that they have registered on HMRC's website, or indeed going onto the HMRC portal and looking and checking that they have got GPS. So yes, it is something that comes up, albeit I'll circle back on whether or not Howden has received a specific claim for it.
Brilliant. And one last question, which might just be how long is a piece of string, but the question is, how much does WI typically cost? Is it as a percentage of the proposed sale price, or is it just so diverse that that's a difficult one to answer?
No. It's a very reasonable question. I think, and not too difficult to answer. So W&I, as I say, it's there. And this helps frame how much policy limit that you buy, how much insurance you want to purchase. So let's take, to make the numbers easy, because my mental arithmetic is terrible on the spot. But if you take a transaction that's 100 million, let's call it one single, marquee asset, the W&I market across all sectors, all businesses, it's market standard to take insurance of between 10 and 30% of that transaction value. So anything between 10 and 30 million in this example. Now, the cost of that is expressed as a rate online, basically as every other insurance policy is. And for hospitality at the moment, operating hospitality businesses, the rate online could be something between 0.55% and 0.7% of your exposure. So to put that into actual numbers, 100 million deal, 10 million policy limit, your premium might be somewhere between 55,000 and 70. What I will say is, though, that when it comes to W&I insurance, there are a multitude of costs that go along with it. So there are, applicable taxes, insurer underwriting fees, and you can purchase all the bells and whistles in the world that you want to bolster your cover. So that's a very, very crude estimate. And also the insurance market, they do have minimum premiums as well. So the lowest all-in cost that you can probably get an insurance policy for is around the 65, 70,000 pound mark, I think.
Okay, that's a great answer. Brilliant. Thank you. We are getting towards the end of our time, but I think what would be really interesting to talk about is how hospitality businesses are valued, and what do you need to know before you can make that assessment. I guess that's Alex. Do you want to kick off on that one?
I'll start it off. Yeah, like I said, essentially a hospitality business is valued on its NOI, and there is a multiplier on that based on the geographic location where you are. So for instance, a hotel in central London has a multiplier that is somewhere in between 20 or 25 of the NOI, whereas a hotel, and no disrespect to anyone from Scunthorpe, but that multiplier will be a lot lower. Yeah, but everything else is in relation as well. And then obviously it's important to see what previous deals have done. Yeah, and there is loads of, I mean, HVS, JLL, all the main brokers regularly produce results and produce transactions where you can also see how much is the price per key. So those are the two benchmarks that you need to keep in mind to see if it's reasonable. And then obviously you need to do your DD, but you also need to have, and I think that's super important, that you have a reasonable comp set. Yeah, if I run a 5-star hotel and I start comparing myself to the Holiday Inn Express, then everything is looking amazing. But that's not the way, and you should have a reasonable comp set and then a slightly more ambitious comp set, and really sort of get into that data to quantify how much more can you do in order to increase what is the incremental value that you as a new buyer can bring to the show in order to drive it forward. And like I said before, if that's not the case, then you should think very, very carefully, because if there's no incremental value, there could be a risk in there. I just want to tag back to what AJ is saying, because if you say 65, 70,000 on a 100 million deal, that is very, very low. Because if you really go under the covers and you find stuff, particularly when the quality of the data during the due diligence is not particularly good, or there is not all the information is there, that is very, very easy to sort of just take that risk away. But coming back to you, and that immediately affects the valuation, right? Because if you find things, if you find things that are incorrect, then obviously the whole thing will drop away. So do your homework is one thing, making sure that you independently look at what you think the situation is in the hotel as opposed to what the previous owner did, because there could be differences. And then make sure that you're covered from all angles so that you can actually start executing that plan as soon as possible.
Brilliant, thank you. And AJ, from your point of view, do sellers normally come to you with what they think it's worth, and presumably you had to do a lot of due diligence on that as well? So
it's well, it's interesting. It's something that the insurers are always going to be focused on. We are but meager insurance brokers in the transactional suite. So, you know, the things with valuations that will come down to, you know, people like Alex, and it's up ultimately between the parties to negotiate between themselves and arrive at a price. Albeit actually skipping back, there was quite an interesting claim that came about where HMRC actually challenged the valuation methodology of a hotel purchase and lease back, alleging that the values were unreasonable, and they actually sought to try and increase the taxes payable, you know, having consulted with the valuation office. So, you know, all things being, you know, it does have to be pretty reasonable. What I will say is, though, that the one thing that we always come back and tell clients is that when you're trying to evidence a claim under the policy, everything comes back to value and how you actually demonstrate your loss. You know, it's very, very easy to indicate that you've had a breach of warranty. You clearly just have to show an incorrect fact pattern. But to actually demonstrate and say how you have suffered, you know, the warranty true versus warranty false position, that can actually be quite challenging. And so we always advise the buyers to keep a record of how the target is valued, and throughout the lifetime of the negotiation process with the other side, how you might have adjusted for certain identified issues, how you might have put some through the completion accounts or otherwise contractually dealt with them, so that in a claim scenario, you're able to show your hand to the insurer and say, well, actually, look, there was an impact on the EBITDA of 10% here, owing to a liability we were unaware of, or an undisclosed contract perhaps, and, you know, plugging that into our valuation methodology, here spits out the loss. Thank you, Mr. Insurer. Please, can you pay me my money? You know, in an ideal scenario, that's how it works. So it's something that's worth keeping in mind, and certainly for buyers and sellers, or particularly for buyers when making a claim, how can you demonstrate how you value the business, exactly as Alex has said.
Brilliant, thank you. And Alex, if a hotel or a hotel owner is considering selling at the moment, they're thinking, all right, I want out and I want to retire, at what stage should they bring you or somebody like you into that process? Would you suggest that they try their hardest to get their house in order first and then bring you in, and then you pick up anything they've missed?
No, well, I think it's working together, and I think it's more a matter of maybe sort of piecemeal, but do something before. Get a plan. I think that's the most important thing. Get a plan, and it doesn't take more than a day and a visit, and say like, okay, do this, that, and that, and then I'll come back to you. I mean, I'm working with one client at the moment. I've been working with them for years actually, and we're slowly getting towards like actually the opening the hotel, but there was pre-pandemic and it's still working, but it's fine because we meet every 6 months. You can steer them in a certain direction and say, well, you know what, you could do better there. You can still get something more there and see if you can get on that crest of the wave and then move forward. This is not a business. My business is not a business of quick bucks, but it's more of a business of making a relationship that lasts, so that people can come back to you. And sometimes that's just a cup of tea and half an hour, and that's okay too. So yeah. It's building that relationship that I value more importantly than doing a massive deal at once. It will come afterwards.
People will be a crucial part of a hotel being ready to sell, whether they're running the technology in the hotel or revenue management. So I'm assuming that in your run up to that process, your key is to absolutely get the right people in the right jobs and making the hotel as commercially viable as possible.
Yes, I think so. But I think at the same time, there's a bit of a conundrum there, right? Because an owner could sell, but he doesn't necessarily want his staff to know, because it could be a long-winded relationship. So it's an assessment of the situation of where you want to be. It's very much a people business, and I think at the right time people should be informed, and then being part of the process. But it's not always as easy, and I'm sure AJ has seen it as well, that people are sort of pussyfooting around a hotel, and we're here to arrange a wedding, right? And then we all look at the HVAC in the building. So it's a difficult one, but like you say, which is very right. I mean, our industry depends on people. AI or no AI, our business depends on the people and the hospitality that we provide. So it's something. It's always good to have a real good conversation with the seller down the pub, and to literally go over like, what is the staffing level here, etc., etc. And then you get a good feel, and you don't always. I remember about one transaction where actually on hindsight, I totally disagreed with him, but at least I hit the ground running and I know what to expect. And I think that's it. But people super difficult, but it's also what makes our industry fun.
Isn't it just? And with all those comments earlier about flirting and dating and tying the knot.
Well, there you go.
Yeah. So
where are we now?
We're all very human values. Well, I think that pretty much brings us to a close. Thank you to those who asked questions today. That was really, really useful. If you do have any more, then please do get back to us. But thank you, AJ and Alex. That was brilliant. And Jane, I'm sorry we missed you. It would have been great to have Jane from Deloitte here as well. But we were well served by AJ and Alex with some very valuable opinions and interesting stories shared over the last half hour or so. So thank you. I just need to say that please remember that today's conversations were informal discussions from our experts. Should you want more formal advice, then please contact your professional advisor directly or get in touch with me and I can point you in the right direction. Do take a look at our website for other upcoming events. We have more webinars scheduled as well as some in-person meetings. Tomorrow, actually, we have our annual finance update from BDO at their offices in Baker Street. And some of the topics we touched on today, like national minimum wage and the construction industry scheme, will be covered during that meeting tomorrow, I'm sure. So you can still register if you want to. It's breakfast tomorrow. And then on the 3rd of July, we are working back with Max and AJ and the team at Howden, and they're going to host a summer evening event for us at their offices. It promises to be a great networking event whilst enjoying drinks, canapes and views over the London skyline. And there's also going to be a special guest appearance. So we will get back to you with more detail on that when we have it. You can find recordings of all of our webinars and masterclasses with a summary of the key points on our website, hosper.org, and today's webinar should be uploaded within the next few days. But thank you for listening. Thank you to Max, thank you to Alex, and thank you for AJ, and we look forward to seeing you all again soon. Take care, everyone. Bye-bye.
Bye-bye.
Bye-bye.